A figure appears on your screen, 0. Your rent is due this coming Friday. Retirement feels like it's 4 decades away and you're only 23. The system hums along, operating without your active participation. Human Resources sends out the enrollment materials, but you open your inbox, glance at it, and quickly scroll past. They mention the 401k plan once during orientation, and you nod in acknowledgement, utterly clueless about what it entails. Your rent amounts to $1,400, and your student loans weigh in at $312 monthly. Retirement seems to be an issue for someone else. You peek at your bank account, $74. You shut the app, feeling as though locking money away until you're 60 is akin to throwing it into an abyss. So you decide to hold off. Your employer offers a 3% match, which is essentially free cash you're choosing to forego. When the loan statement arrives, you see you owe $28,400. You file it away and push thoughts of retirement aside for now. The moment your first paycheck arrives, reality hits hard. You quickly run the numbers and realize just how little you take home. Every month you opt out of the employer match. You essentially give up about $150, money you'll never get back. On a Friday evening, your friends are out having fun and thoughts of compounding interest couldn't be further from your mind. One colleague maxes out his 401k contributions and you unjustly think he's being overly cautious. You're mistaken. It's 2 entire years without a single dollar added to your account, and the balance remains at 0 2 years, equating to $3,600 in lost employer contribution, vanished. The system doesn't issue you a bill, nor does it impose punishment for your neglect, it simply moves on. A coworker finally tells you you're leaving money on the table, and suddenly a light bulb goes off in your mind. That night, just before bedtime, you type 401k employer match explained into the search bar and realize you've spent 2 years passing up free money. You access the HR portal at 11 p.m. and select a 3% contribution, officially signing up at last. You hit submit, and with that, the confirmation screen appears. It may have taken a couple of years too long, but it's finally done. You select the target date fund based on its automatic adjustment feature and trust it implicitly. When the next paycheck rolls in, the deduction shows $93 disappears before you even notice it. 3 months later, you check your balance, $1,847. You experience a mix of pride and confusion. You contributed $900, yet it grew by $1,353 thanks to the employer match doing its magic. At the 6-month mark, your balance hits $3,200. The market may have fluctuated, but you decided not to change a thing. Even when it drops by 8% in just a week, causing your balance to decrease to $2,940, you choose not to panic. You refrain from making any moves, close the app, and simply go to bed. You realize it indeed grows without your constant attention. Initially unsettling, the thought becomes liberating. You gradually stop checking weekly, stop stressing over the numbers. Your strategy begins to take shape. At the end of your first year, your enrolled balance stands at $4,100. You contributed $1,116, with the rest coming from the system. After 4 months away, you check again and find the account has grown in your absence. By the age of 28, you have $7,600 in a fund you barely grasp, and it continues to rise. Contributing 3% ensures you receive the match, and selecting the target fund takes minimal effort, then you leave it be. That's your entire strategy. A new job offer comes your way with an annual salary increase of $12,000 along with a better title, and you accept without thinking twice. After your final day at the old job, HR sends over the 401k distribution notice. You find yourself with 60 days to make a decision about the $11,400 in your old plan. After considering the numbers and factoring in the 10% penalty and taxes, you estimate that cashing out would leave you with about $7,800. That's 4 months of rent. While mulling over it, you think to yourself that you'll contribute more in the future as your income increases. You almost convince yourself, but an article or statistic stops you. So instead of cashing out, you choose the direct rollover, ensuring the entire $11,400 transitions to your new plan, meaning no losses. You start your new role and enroll in the new 401k plan on your very first day, this time, without delay. 18 months later, the market experiences a significant downturn. Your balance slips from $18,000 to $14,000. Daily, you log in, consuming articles on recessions, feeling a loss of control. Yet, you don't sell not from knowledge of market cycles, but due to sheer paralysis. Thankfully, your balance starts to recover. After another 18 months, you're back up to $28,000. Freezing during the downturn turned out to be a wise choice. You're now 32, still contributing the minimum of 3%, but are actively engaged in your financial journey. A substantial raise prompts you to increase your contributions to 8% while keeping your lifestyle unchanged. This additional percentage disappears from your income before you feel it, marking your first genuine decision within the retirement system. This is no longer sheer luck, but an intentional move. Your account grows by $800 in a month when your contributions total only $490, leaving you bewildered. After researching compounding interest repeatedly, you finally grasp the concept. During a strong quarter, you see gains of $6,000 without lifting a finger. The understanding dawns on you. At 34, your balance surpasses $60,000. You capture a screenshot but choose not to share it. It lives in your camera roll for just 2 days before you delete it. You resist posting or discussing it over dinner. This sense of privacy isn't just modesty, it is a matter of discipline. This year, your account earns more from returns than from your own contributions. When your balance reaches $90,000, you open a retirement calculator for the first time and adjust various parameters slowly. The projected figure leaves you breathless. You realize you are becoming a passenger in a journey you initiated. The complexity of the machine has grown beyond your initial inputs. At 36, you have $90,000 saved and find yourself feeling less apprehensive than before. As your balance surpasses $100,000, you capture yet another screenshot. It remains in your camera roll for 3 days before being deleted, deliberately so, as privacy becomes paramount. You max out contributions at $23,000 annually, automatically hitting the IRS limit without reconsideration. This arrangement has evolved into a structured approach. The math has changed dramatically. With a 7% return on $150,000, you might earn $10,500, while on $30,000, the return was just $2,100. After contributing $23,000, the market adds $10,500 on top. This year, your account amplifies by $33,500, nearly the same amount as you made in your entire first year of work. You begin to understand your role in this journey. Your friends remain unaware of your saving success. You never correct their assumptions, never disclose any details, opting for silence not as modesty but as a demonstration of discipline. When the market takes a downturn and you see your balance drop from $180,000 to $156,000, you simply hold firm. Entering the age of 42, you approach $200,000, $23,000 contributed by you annually, while the machine manages the rest. Upon crossing the $200,000 threshold, there's no celebration, no announcements, just consistent contributions. Compounding now does more work than you, and your focus shifts from building to protecting what you've established. You manage your portfolio carefully, reading financial literature and tweaking your asset allocation. After experiencing a market drop of 22% over 8 months, your balance declines from $370,000 to $288,000. Yet you remain calm, continuing your contributions through the downturn. 14 months later, the balance climbs back above $400,000, all achieved without any drastic moves on your part. Your understanding of finance deepens, discussing terms like asset allocation and rebalancing with newfound confidence. By 50, your balance reaches $440,000, and a sense of assurance starts to settle in. You refrain from voicing your optimism, as if uttering it might adversely affect your earnings. As your children finish college and your mortgage is down to its final 4 years, you can finally see the fruits of your long-term planning. You find yourself in a new position with $3,000 a month that you weren't utilizing for yourself before. The obvious question arises. As you approach 50, the IRS adjusts your annual contribution limit to $30,500. You reach that ceiling without hesitation. Annually, you set aside $30,500. There are no exceptions, and you avoid lifestyle inflation. The goal feels achievable, and discussions about retirement start to feel genuine. On a Tuesday evening, you pull up a spreadsheet with your partner, exploring what age 58 looks like, what 60 entails. You establish a concrete target date. Now, you consider delaying your Social Security benefits and include healthcare expenses in your calculations. This is what financial planning entails. You now integrate an estimate for healthcare costs to bridge the gap between retirement and when Medicare kicks in. You prepare for this. Your account balance surpasses $600,000. The monthly growth exceeds what your first full salary ever was. You reflect on your 23-year-old self with unread emails and a checking account balance of $74, surrounded by uncertainty. The gap between $74 and $700,000 is not due to luck or brilliance, but simply the passage of time. The mortgage reaches its conclusion, and you make that last payment, one fewer obligation hanging over your income for good. By the time you're 58, you might be nearing $800,000. Retirement feels tangible now, no longer a mere dream. Previously, you talked about retirement as something in the distant future. Now you say retirement in 4 years. That's the major shift. As you receive your statement, it reveals 7 figures. You read it as you would a utility bill. 7 figures. You anticipated that it would feel more monumental, but it feels just like another Tuesday. Closing the statement, you realize you are 61. 2 years ago, working became optional, but you haven't fully embraced that freedom yet. You continue to contribute annually out of habit. Stopping now feels strange, not required. In a prosperous year, your portfolio gains $80,000. Your contribution of $30,500 seems minor in comparison. Now you contemplate withdrawal strategies, Roth conversion opportunities, and the risks associated with the sequencing of returns. You strategize. You start gradually converting segments of your traditional 401k into a Roth account in a thoughtful, tax-efficient manner, incorporating concepts like safe withdrawal rates and asset location. The language of retirement has become entirely familiar to you. You hold a number that exceeds your needs. You lived a life marked by quiet consistency without fanfare. Your monthly statements reveal totals higher than your initial salary. At some point, work transitioned to an optional choice. You engaged with the system long enough that its language is now second nature to you. 40 years have passed. You once were that 23-year-old with $74, with rent coming due, thinking retirement was a distant issue. You hold no resentment for those who overlooked this. You do not judge. You remember being in their shoes. The journey demanded no grand gestures, brilliance, or sacrifices, just patience and perseverance. That was all it took. Somewhere, a 23-year-old is sitting through a new higher orientation. Human Resources mentions the 401k, and he nods before moving on, with $0 saved. He believes retirement is a concern for the future and isn't worried. He is unaware of the upcoming costs, but he will be, eventually. If you've enjoyed this journey through financial planning and retirement projections, consider subscribing to Billy Finance. We appreciate you joining us today. Feel free to leave your thoughts in the comments below. Goodbye for now.